If you have 10 renminbi, you can start trying it out. Today, we are learning about hybrid funds. If you open the Tongwashen Fund report, you'll find that the returns over the past year, 3 years, 5 years, or even since inception look pretty good, and most of the top-ranking funds in your hands are hybrid funds. Why are hybrid funds so powerful? The reason is simple. The stock market has short bull runs and long bear markets. In the long run, only hybrid funds with flexible asset allocation can maximize returns in a bull market and save a decent amount of money in a bear market. Stock funds generally require over 80% of assets to be invested in stocks. Bond funds generally require over 80% of assets to be invested in bonds. Sector theme funds, over 80% of non-cash assets must be invested in the corresponding industry or theme. In other words, many funds are not allocated however the fund manager pleases. Their boundaries are drawn early on by the fund contract. So, fund managers can't just buy whatever they want. They have to operate within a designated rule circle. Exactly. The advantage of hybrid funds is that this rule circle is much more flexible. Because of this advantage, as of the end of March 2026, out of approximately 13,900 public funds in the entire market, about 4,900 are hybrid funds, making them the largest category by number. That sounds great. Isn't that like the Yuanyang, split, hot pot of the fund world? Don't mistake all split hot pots to be the same, they come in all varieties. Some hybrid funds are quite steady, like a bond fund with a little bit of stock added. Others are highly aggressive, essentially being a stock fund with just a tiny dash of bonds. The 4 categories of hybrid funds. Conservative hybrid funds, biased toward bonds. Allocation, typically 30% stocks, 70% bonds. Risk level, generally medium-low risk. Features, focuses on stability, using a small portion of stocks to boost returns. Its volatility is far lower than equity-biased funds. Note, is it 100% safe? No. Bias toward bonds doesn't automatically mean rock solid. You must look at whether it holds a lot of convertible bonds or how high its stock allocation actually is. Some products sound like bond funds but carry significant volatility. You think you're getting rich steadily, but you end up walking straight into a wolf's den. Balanced hybrid funds. Allocation, balance between stocks and bonds, with stock allocation typically around 40% to 60%. Risk level, generally medium risk. Features, in theory, it gains more than conservative funds when markets rise, and resists drops better than equity-biased funds when markets fall. Returns are relatively stable, neither too aggressive nor too conservative. Flexible allocation hybrid funds. Allocation, highly flexible. Stock allocation can move freely between 0% and 95%. This is the breeding ground for 10-year megafunds and star fund managers. Features, ultimate flexibility. Stock allocation can be maximized in a bull market and minimized in a bear market. Returns depend heavily on the fund manager's capability and style. Tip on choosing managers. Look for those with 10 years of experience and an average annual return of 15% or even 20% 好价. If they have managed the same fund for over 10 years, it is well worth studying. I'll organize a list of these star managers for you next time. Aggressive hybrid funds, biased toward stocks. Allocation, high stock exposure, with many products maintaining over 60% long-term. Risk level, generally medium-high risk. Features, strong offensive capability but high volatility. It is not rare to see double-digit drawdowns during market crashes. The risk is slightly lower than pure stock funds, but still very high. Before buying, you must check its stock allocation, top 10 holdings, industry concentration, and historical drawdowns. Otherwise, you might think you bought a hybrid combo meal, but you actually bought the volatile stock market index. The 4 hidden traps of hybrid funds. Some classmates ask, hybrid funds sound great, but there must be plenty of traps, right? Absolutely. Trap 1. Flexible in the stock market does not equal good. Many people assume flexible allocation means the fund manager can perfectly time the market, buying at the absolute bottom and selling at the absolute top. In reality, this is incredibly difficult. When the market crashes, liquidity issues, fund size, and holding restrictions mean they can't just sell everything instantly. Managing 10,000 renminbi is completely different from managing 10 billion renminbi. Trap 2. Selling dog meat under the label of sheep's head, misleading labels. Some funds are named balanced hybrid, leading people to think they are balanced across stocks, bonds, and industries. In reality, 80% of their stock portion might be locked into a single day's hype sector. Some claim to be flexible allocation but hold high stock positions through thick and thin. Others suffer from style drift, frequently swapping holdings to chase hot trends without independent research. A split hot pot doesn't mean it's strictly half mild and half spicy. Even if it is, you might still get burned. You must choose the flavor that suits you. Trap 3. Fund manager turnover. The soul of a hybrid fund is its manager. Once the fund manager leaves or changes, the fund's investment style, allocation strategy, and performance can take a 180-degree turn. Many beginners only look at past performance without realizing the manager has changed, walking right into a massive trap. Trap 4. Looking only at returns and ignoring drawdowns. beginners easily buy funds based solely on leaderboard returns. However, many funds on those lists just happen to explode during a specific phase. By the time you chase them, it might be the tail end of their glory moment. We've all been there. The moment you buy, it starts diving. Therefore, when buying a hybrid fund, don't just ask how much it made, ask how much it lost at its worst, and how the manager handled the drop. Are the returns stable over the long run, or did they just explode in one single year? Is the current manager the same person who created that historical glory? A 5-step actionable framework for beginners. Check the type. If you fear big drops, don't jump into aggressive, equity-biased hybrids. If you want high returns, don't buy a conservative, bond-biased hybrid and complain that it grows too slowly. Check the allocation. Don't just look at the fund's name. Check the actual percentage of stocks versus bonds. Check the drawdown. The maximum historical drawdown reveals a fund's true personality far better than short-term returns. Check the fund manager. Look at their tenure, management experience, and style consistency. Is the fund's good track record actually achieved by them? Check the holdings. If the top 10 holdings are concentrated in a single sector, expect massive volatility. Summary. First, check if the fund manager is strong, then check if the fund itself is reliable. Final takeaway. A hybrid fund is not a magic bullet, it simply gives the fund manager more room to operate. Think of it as a combo meal packed for you by the fund manager, but that meal isn't necessarily right for your taste. Before buying, you must understand exactly how many stocks and how many bonds are mixed in, as well as the manager's capability and style. The fund name is just the packaging, the asset allocation and holdings are the actual ingredients label. Historical returns belong to the past, your risk tolerance is your true bottom line.